In this video, I'm going to show you how to correctly use support and resistance concepts to make more money in your trading. Lots of traders use the concepts of support and resistance. In fact, it's probably the most widely used technical analysis concept in all of trading. But 99% of traders get it totally wrong. And why is that important? Well, if you use support and resistance in the right way, it can be a brilliant way to get highly accurate entries and exits for your trades. However, if you use it incorrectly, you are setting yourself up to lose almost every single time that you come to the markets. So, really quick, here's what support and resistance looks like. Resistance is an area, usually drawn as a line, that in theory will cap price and stop price from going any higher. Support is the opposite. It acts as an invisible floor for price. However, this basic way of trading support and resistance is very predictable and therefore very dangerous. Let me explain. Market makers and institutional participants know the mass market psychology and know the way in which the majority of people trade. And being the single most commonly used technical analysis strategy, if you use support and resistance in the same way as everyone else, you are an easy target for what we call liquidations or liquidity runs. This is where price trades through a support or resistance level, hits the stop losses of the traders trading from the buy side or the sell side, and then reverses back into the range and goes the other way. You may have encountered this more than once if you've been trading support and resistance for any amount of time. In simple terms, this happens because hitting stop losses opens up more buying or selling orders in the market for the larger traders, the market makers, the institutional participants. Now, I'm not going to go too in-depth on liquidity in this video. You can hit the card somewhere at the top of this video to check out a liquidity lesson. So basically, when you use support and resistance in the same way as everyone else, you are painting a target on your back that says, market makers, please stop me out. And I'm sure we don't want to be doing that, do we? Now, there is another way to trade using support and resistance aside from the liquidity concepts that I've just mentioned. And this is what we call key psychological levels. Key levels refers to major price areas where institutional participants are taking profit. Now, that sounds confusing, but basically that just means it's areas where banks, trading firms, and big traders are closing their trades. And one great thing about the lesson I'm about to show you, key levels are actually easier to draw than basic support and resistance. So you shouldn't have any difficulty understanding the process. Right, so how do we draw key levels? Well, that's easy. To draw key levels, all we want to do is identify the 0, 250, 500, and 750 levels. For example, on USD JPY, 139.0, 139.250, 139.500, 139.750, and then 140. These would be the key levels within that 100 pip range. So from that explanation, you can see that they're actually very easy to apply to our charts. So basically, we could draw a key level at every 25 pip interval in the market. Now, we probably don't want to do that because if we do, our charts will look like this. A bit too messy, and like all concepts, if we overdo it, it's just going to add confusion to our trading. The best trading is simple. So what we should be doing really is pairing key levels with other points of interest, as these are the key levels that are most likely to have reactions and add a benefit to our trading. So for me and my trading strategy, I like to pair my key levels in areas of supply and demand. The majority of the other key levels I will not be too interested in, though they will have a use that you'll see a little bit later on. Having key levels inside of the supply and demand zones gives me an extra layer of confidence in my work. And also, the market will very often come to tap the key level. So if we have a key level inside of a demand zone, we can actually use that for a very precise entry to maximize the profit on our trades. So if there's a key level inside of our demand, that would be a really good point for a buy limit. And if there was a key level inside of a supply zone, that would be a really good point for a sell limit. This is how we use support and resistance for entries. Now, when it comes to using key levels for exits, it's a slightly different story. This information is not going to be so relevant if you are a day trader, but if you ever hold trades that run 50, 70, 100 pips or even more, key levels can actually be a brilliant place for considering exits and profit taking on your trades. So in this example, we see how well price hit the 500 key level, failed to close above, and then ended up selling off. Taking profits there would have been a brilliant idea. And then back on the sell side, we see how the market failed to break through that 0 key level before pushing back to the upside. Once again, giving us a good place for entries or for exits if we were selling the market. When we see the market fail to close below or above these levels, it indicates to us that there is a lot of buying or selling taking place at those areas, which is therefore likely to shift the direction of the market, hence giving us an early exit or a good entry for our trades. Here's an example of a trade I took using key levels for entries and for exits. Now, for this position, I wanted to buy from demand. So to refine my entry further, I actually used the 750 key level for my buy limit. As you can see, we hit 133.750 perfectly, and that's actually where we got into the trade. This got me the most precise possible entry to the trade, helping me to maximize the profits I could make on the position. Now, just in here at the 136.250 level, after the market failed to close above at this point, I took some profits just in case the market rolled over. Now, obviously, as you saw in this example, we did continue going up, but a lot of the time the market will just reverse. So taking profit when the market fails to close over key levels is never a bad idea. And for my target, well, the 250 key level lined up perfectly with my supply. So that was an easy area for me to close up the trade. So as you can see, key levels can be a good place to get into and out of trades, and using the key level method of support and resistance will also stop you from getting caught in the traps that the majority of retail traders are getting stuck in with those liquidations we spoke about before. Remember, key levels are not going to work every single time, just like everything else in the markets. So make sure you have other confluences in mind when you're trading them, and also make sure to always adhere to a good risk management strategy. That is how you can use support and resistance the right way to benefit from precise trade entries and exits and avoid the traps that the other support and resistance traders are going to get caught up in. Now hit the link in the description and check out my free courses. There's more information on liquidity and the right way to trade support and resistance in there. Thank you for watching. I'll see you in the next video.